Sure. So a mortgage bond is security that is registered in favor of a lender or any sort of creditor um, in order to secure any debt that's due to it by the person that's actually mortgaging the property. So you typically find this in the finance space as a first-time home buyer or any sort of buyer would buy a property and they would want to own this property, but they would mortgage the property. So they would be the mortgagor, and they would mortgage this property in favor of the mortgagee, the creditor, in order for the creditor to have some form of security that would give it comfort in lending money to the mortgagor. So the buyer, the investor, whatever the case is. And so when we speak about mortgage, it's really just a form of security. Now, this mortgage secures a loan. The loan is the debt basically that the credit provider, or the amount of money that the credit provider provides to the property investor or the property buyer. So that's a loan. Now, when we start speaking about access bonds, you need to remember that primarily, especially when you're dealing within the banking realm, in order to grant a loan, the banks would actually open up an account. So this would almost form a ledger of the different transactions. So you'd see every month there'd be some form of service charges, there'd be interest, there'd be then a capturing of the actual payments that have come in, and these would obviously reduce the balance until you start eating into your capital. So what people need to remember, especially first-time home buyers when it comes to buying houses, is for the first couple of years, the majority of the charges, let's say the debits on your loan account or your mortgage account or bond account, whatever you want to call it, is predominantly interest. So interest forms a massive, massive part of it. So your payments normally go towards the interest and the cost first, and then you start seeing a slight reduction in capital. As the capital reduces, your interest rates would also reduce. But because within the first few years, that capital reduction is so little, you need to almost build up that momentum and get it reduced quite substantially before it starts impacting or reducing. It doesn't reduce the interest rate, it reduces the interest charge. So the rate stays the same, but the rate is now being charged on an amount that's slowly reducing. And initially it's small reductions, and then slowly it starts becoming bigger reductions. Why? Because obviously as the interest becomes less, the interest charge becomes less, and the capital starts reducing more and more. You start finding that the more you pay, the more you're able to reduce the capital, the more you're able to reduce the interest charge, and this basically snowballs. And so access bonds are typically when they've got the account and a person can keep depositing money into this account, and this would go towards a reduction of the amounts that are actually payable within, in terms of that loan agreement or that mortgage account. And this works fantastically for investors because you get the impact or the effect of actually being able to reduce your interest charges.
Just a minute.
Sure.
Just a minute. Can I get in there because it's interesting that there's something
So I'm not going to speak as an expert within the banking system and the way that these accounts are actually set up internally. I'm only going to speak from the experience of some of the accounts that I've dealt with or that I've seen. So, for example, one of the accounts that I've seen with Nedbank is it is just one account. It is just one account number, but they don't. So the benefit of the access bond, and this is where the upside comes in, is the investor can access that excess cash. So even though it contributes towards the reduction of the interest charge, it is still accessible. So it's not a payment that's made and then you lose it. And even though you get a benefit from having made the payment, you can never get it back. So you can extract the money back when you need it. So to answer your question, Tabi, it is accessible, so it almost feels like it's in a different. It's kept different from the other payments. The other payments are due; they have the effect of reducing the interest and capital, whereas these payments have the effect of reducing the interest charge, but They don't get committed, and they stay there and they are accessible. So that's one thing that we need to bear in mind. Is for us as investors, it doesn't really matter how the banking system itself looks like, whether it's one account, two accounts. I've seen it as one account. What is important as an investor is that these amounts go into the account and they stand as available balance that is accessible by an investor when they require those funds, be it to purchase another property or for utilization. And because because you want to reduce that interest charge, and it's one of the best interest rates that you're going to get. Because think about the equivalent of going to a bank and getting an investment that's accessible, like a on-demand investment bank account that you open, and you get a certain interest rate for their bank account, whatever it might be. The interest rate that you're actually getting in these access bonds is the same interest rate that you're paying, which means that if you're going for a secure investment at a relatively high interest rate, this is actually a great place to store your money. It's not as great as obviously the income you can get from property investments and shares and speculating in business. But if you're going to park your money, why not park it in a place that gives you that upside of the interest rate that you're actually paying on your bond? So yeah, I find it extremely beneficial to use such access bonds. And I do have to point out, like for example, Absa structures things in their own way. They've got universal accounts where an investor can own multiple properties with different entities. So how they structure their bank accounts, it's a question you're going to need to ask them. As I understand it, the excess account is still under the same account number, but the monies almost feel like they're ring-fenced from the monies that are paid in reduction of the capital.
Wow, awesome. So basically, in short, this